So earlier today, I had a conversation with a couple who is interested in a whole life insurance policy. Cash value is their goal, and they want to start with a lump sum of $200,000. That's how much they want to deposit into their policy. Day one, they want to start with a lump sum. They're front loading the policy. They want to continue to fund the policy beginning year two. However, they don't want to be committed to a large premium. So the case study we're going to look at will resemble what that couple was interested in, where we've got a situation where again, they're starting with a large lump sum, $200,000. And what we'll look at in this particular case study is $50,000 per year thereafter. Now, when I say $50K per year thereafter, this is not what they're committed to. What we have a case of here is a policy where my minimum commitment is about $10,000. You'll see it's actually a little bit less than this, but the design is as follows. I'm starting with $200,000. Then I have the ability to go up to $50,000 per year, but I'm only committed or billed for $10,000 per year. So I can start with a very large deposit. I have the ability to keep on adding to this policy, but my minimum's at a low enough number where I'm never stressed out by the policy. So the first question we've got is, what is the true minimum premium? You'll see that the minimum premium is $5,000, but we've got other riders attached that results in a true minimum of about $7K, meaning what they would have to pay each year if they want to continue to fund it. We're going to look at an illustration in a minute. What we'll also look at is two product versions. So we're going to look at the same product, but two different versions. One will give us more cash value up front, and the other will give us more long term. This is one of my favorite things to do, presenting one product, but with the two different versions. This way I can see up front, which option do I like more? Do I prefer to have maximum liquidity from day one and an early break-even point? Or do I look at the numbers and say, I'm still cash rich up front here with the long-term option, and I'm not going to need access to all of my money. It's always a personal decision. So we'd like to show both options in a case like this. So we're going to look at the policy design, but before we do that, let me actually go to the illustration here. And this will be beneficial because you can see exactly where your money is going. So if we look at the charts and such, down at the bottom or the second half of the illustration, we got a lot of columns. This column, net after-tax outlay, or net premium, displays how much you are paying into the policy each year. So this example displays $200,000 in the first year and then $10K per year thereafter. Okay, that's great. We're going to look at these on Excel in a minute. But of that $200K and even the $10,000 per year thereafter, if this is me and I want to understand the policy, maybe not every detail about it, but I want to understand the basics. If someone asks me, you bought a whole life insurance policy, don't people get ripped off with that? I can confidently say, yes, I have heard that a lot of people do get ripped off or taken advantage of. However, my policy is set up properly because of reasons A, B, and C, which are as follows. Of the $200,000, here's my premium up here at $5,000. Then I've got this, $936. This is term insurance. Then I also have this down here, another $770, which is also term insurance. These are the premiums for the term insurance rider. So the true minimum commitment, if this is you, this 45-year-old individual, it would be the base premium plus the cost of this term rider. This is your renewable term rider. And then also this guy, the cost of your 1-year term rider. So you've got a lot of term insurance attached to this policy, and we'll go through the purpose of having this on a policy in a minute. It has to do with your MEC limit and preventing a taxable event. But there's your minimum commitment. Adding those up, you're at about $6,700. So the true minimum, if we round up, would be about $7,000 per year. We just rounded to $10,000 just to make it a clean number. So if the true minimum is $7,000 and we round off to $10,000, like what we have here, where's that extra $3,000 going? It's going toward PUAs, your paid up additions rider, which will optimize your cash value. So Note this is a lot of information. Let me go through a breakdown as to how this works, because this has helped a lot of people, including myself, when I first attempted to understand how whole life insurance works when it's set up for maximum cash value. So we've got what going on here. How much is this individual paying into the policy in the first year? Well, he's starting with $200,000. Of that $200,000, where is his premium? Do you remember what that number was? It was $5,000. And this is a Guardian policy. Guardian, as a company, will allow us in the first year to illustrate a maximum of whatever the base premium is, times 50 to go into PUAs. So we can slug a huge dollar amount, a large lump sum, and front load a policy in year one, which is really, really nice. Beginning year two, provided we have a term insurance rider attached, specifically a 1-year term rider, the maximum we can illustrate in PUAs is 10x the base premium. So the maximum they wanted to pay in was how much? Aside from year one, $50K per year. Where did we come up with that $5,000 minimum premium? We took the desired payment, beginning year two, the maximum desired payment of 50, how much they think they can pay in. It took 10% of it, and that's where we set the premium. So that's specifically how we came up with the $5,000 premium in this example. We're saying, how much do you want the ability to pay in? What's your maximum number? And then I want to set that premium as low as I can. Here's why. The premium piece with this product does not build any cash value in the first year. Beginning the second year, what you will see, and you'll see this when we go back to the illustration, the premium does show up in cash value. Again, this is beginning the second year. And I like to say that because when we hear the word premium, usually what comes to mind? Cost, expense. I'm getting insurance that I hope I never use, in this case life insurance. I hope I don't have to use it anytime soon because the insurance benefit, the life insurance, is paid out when I die, hence the term life insurance. But from a cash value perspective, it does not all just go toward the death benefit. Beginning the second year, with the product we are looking at, you will see it come back to cash value, which is nice. Now the premium does buy us death benefit. PUA piece, the first example was about $193 in the first year. And then each year thereafter, well, it depends how much we pay in. If I'm paying $50K, it's $43K. Why it's $193 is because we also had approximately what? $2,000 directed toward our term. So the total is $200,000. That's how much I'm starting with. A breakdown as to where the money is going. You've got the $5,000 premium, the $2,000 term insurance rider. Add those two together, you have $7,000 plus this $193,000 PUA payment. Add them all together and you get the $200K. Now the term insurance rider, the purpose of this, sometimes people ask, what do I need a term insurance rider attached? Because now I'm spending an extra $2,000 on this policy because we have a lot of term attached to this one. The reason why we attach it is because it increases the death benefit at the lowest possible cost. The death benefit has a direct relationship to this MEC limit. MEC stands for Modified Endowment Contract. Why so many people are attracted to cash value life insurance are because of the core benefits: safe, liquid, and tax-free. The tax-free piece is tax-free unless I trigger this MEC, this Modified Endowment Contract. Any life insurance policy can become classified as a MEC, and if it does, the cash value will still grow tax-deferred. However, if I plan to access the cash value, I've got to pay ordinary income tax on the gains. And if I'm under the age of 59 and a half, I might be subject to an additional 10% penalty tax. So we don't want a MEC to occur. Every policy has a MEC limit, which is simply the maximum dollar amount you can pay into the policy each year. And it has a direct relationship to the death benefit. So where we came up with the death benefit and the amount of term we have attached to this policy is to give us a MEC limit of, guess how much? $200,000. So when someone says, I'm interested in a whole life insurance policy and I want maximum cash value, what we'll do is solve for the minimum death benefit possible in order to get the desired MEC limit. And how we come up with a MEC limit is based on how much you want to pay into the policy. This individual wants to pay $200,000 in the first year, so I know we need at least a MEC limit of $200,000. A lot of stuff. I hope that made sense. Back to the illustration, you'll see everything we just went through on the whiteboard match up here, where you've got a $5,000 premium, and you've got the term rider, you can round up there to about $2,000, and then we're plowing the rest into PUAs. The term rider cost, specifically this piece, the 1-year term, is covered by the PUA payment. So this number, we need to factor in the term cost first, and then everything above that is going into PUAs. Back to the funding plan here, because that was a breakdown as to where the money is going. And the minimum premium is what? $7,000. $5,000, but the premium plus the term, $7,000, that's his minimum commitment here. What we're going to look at is $200K in the first year, then $10,000 per year thereafter. So you can see if this is you, what's it look like if I just paid 10K? That's a number I know I can handle. I'm very confident that I can pay that every year. If I add more, that's great. But first, let me see what it looks like with more of a conservative scenario, me paying just this 10K or funding just this 10K. Then we can look at the same illustration, the exact same product, but with funding 50K per year. So now I can see what it looks like if I add more money into the PUA. So if I'm paying a total of $10,000 per year and I want to add more money to the policy, let's say I get a bonus or I sell a piece of property and I've got a lump sum of cash here, well, depends on the company. In this example with Guardian, I could just pour it right into the policy via PUAs. Different companies have different rules. The policy has to be set up correctly to handle funds like that. We've got videos that go through all of the details on PUA flexibility and such. But let's take a look at these, shall we? What we'll look at first is what we just discussed. We first looked at this guy, which was the 10K per year. Look up here. There's the breakdown as to where your money's going. 5, 936, 44, 150, 200. Got all that memorized? Did anything change? Not up here. What about down here? Ah, yes. We've got the $50,000 per year going in now. So this is their plan. What they want to do, or he wants to do in this scenario, 50K per year. The difference is that he's committing to this and setting it up where he can add more at his discretion. Okay, now let's look at Excel. So we mentioned options A and B. Do you remember those? If you would, feel free to comment below on which one you would pick, depending on your situation. More cash value up front or more long term. And side note on this one that has more up front, based on the guaranteed values, it's got more long term too, meaning if we compare the guaranteed cash values with both of them, the option with more up front is stronger from start to finish. It's based on the non-guarantees that the long-term option has more. So what do we have here? Minimum commitment, $7,000. That's the premium plus the term rider. Then our PUA payment, $193. Add that together. What do you have? $200,000. This illustration, we've got 200 in year 1 and then 50 per year through year 10 in this example. Here we've got the total funding. This allows you to easily see what's the total amount you've paid into the policy that you funded. You took money in cash, it was yours, and moved it into the policy. So what's the total amount I funded the policy with over time? Next column, or 2 columns, cash value and death benefit. What's highlighted in yellow is your break-even point, which is the first year your cash value is equal to or greater than your total payments, your total funding. Year 3, that's strong, by the way. And this is the option where I've got more cash value up front. It has a lower PUA fee is what it is. It's Guardian's product with PUA fee of 5%. First year, paying 200. Your cash value, 188. Without pulling out a calculator, if it was 190, that would be 95% of your deposit that shows up in first year cash value. That's cash rich. How you attain that is with a low premium. If the base premium is higher than $5,000, one, you obligate yourself to a larger minimum commitment, but remember the base premium does not show up in cash value in the first year. So the only reason that would be lower is if I reduce the base premium with this particular product. Strong break even. Now we're going to look at the exact same product, but with a higher PUA fee. So the premium is the same, but a higher PUA fee. The logic behind this from the insurance company standpoint is if you give us more money up front, we should be able to go out in the marketplace, earn a higher return, and we should be able to give you more money long term. I emphasize the word should because this is based on the non-guaranteed values, which is good to be aware of. So, exact same policy here. What's the difference? Look at your first year cash value. There's the difference. It's about $10,000 less when we look at it. By year 3, the option with more upfront broke even over here. You're still about $12,000 behind, and you're technically breaking even, where you're positive, in year 5. It's between years 4 and 5 when we look at this. So year 5, you've got more money in cash value than what you've paid in. And again, identical designs here, just a different version, because you've got a 5% PUA charge and then a 10% PUA charge. You'll see that on the illustrations as well. Long term, you will see the option on the right, yield more value. Typically, it's between years 10 and 12 or 10 and 13, where we see the long-term version illustrate more value. And do we see that here? We do. So by year 12, that's your first year, where you've got more cash value in the long-term version than what you have in the upfront version. But again, we've got the two side by side. So let's take a look at this illustration where we've got more cash value long-term. We're going to go through an exercise here. And the exercise is meant to demonstrate what the policy looks like if you fund different amounts. So we've got the same product here, same version. Up top, we see same product, different funding scenarios. What I can see here is if in year 1, I pay in $200,000. So if I'm you, my plan is to start with $200,000, then commit to $10,000 per year. I get a breakdown here of where my money is going. I see the true minimum if I want to reduce it lower than 10K, but if I'm going to fund 10K, I'm just throwing some into PUAs. So here's what it looks like. If I fund 10K per year, this is the illustration we just looked at. There's my cash value. There's my death benefit. That gives me the $200,000 MEC limit. Okay, great. Continues to appreciate over time. That's what it looks like if I fund what I know I can fund. What does it look like if I fund what I think I can fund, 50K per year through year 10? I've got the two side by side now. So now I've got what I know I can do and then what I think I can do. Again, exact same policy. And typically, an individual like this, what they'll do is set it up where this is what they're billed for every year, the 10K per year. And if they want to add more money to the policy, specifically to the PUA rider, they're doing that at their discretion. That's through either an online account, a mobile app, maybe it's a wire transfer, maybe it's a check. Very, very flexible there. Flexible PUA riders are nice. But the additional amount is at their discretion. They're not obligated to do that. This is simply showing what it would look like if they do add the extra funds. How about something creative? We like to be creative, or at least we like to attempt to be creative. I know many people that are much more creative than I am. How about this? Look at this guy, and what I'm gonna do is shrink this down a bit. I should say get rid of the other ones for now. All right, so what do we have here? Same policy. What's going on with the funding? Well, it varies. First year 200, then he does 10, then he has a good year where he throws in 50, then 10 for a couple, then 25 for several, then 50 for two, then back to 10. This is meant to illustrate the flexibility and the fact that we can do something like this. Now, the policy has to be set up correctly. Specifically, we have to have a 1-year term insurance rider if we want to be very aggressive with the PUA payments. So here's the actual illustration. So same thing up top, premium, term rider cost and everything. But here is the key on this. In order to be creative like this, where I've got a 200K lump sum, but then I'm 10xing the premium. Down here, I'm 5xing it for a couple of years, then 10xing it by paying $50,000 in. I do it again at years 18 and 19. This is many, many years after I started the policy. I'm adding large dollar amounts. When you add money into PUAs, what that does is buy you more whole life death benefit. You can actually see the whole life death benefit increase in this column. Total face amount of adds, a way I like to explain this column is it's telling us how much face amount, whole life face amount, another name for the whole life death benefit is our base face amount. It's saying how much face amount or whole life insurance is added to the policy from our PUA payments and dividends that are added. Point is, we're getting extra whole life insurance when we're pounding money into the policy. Usually, when I'm adding large PUA payments and my whole life death benefit goes up, there's a cap where a company says you can only pay so much into PUAs. If you want to add more, we want to put you through a medical exam again because you might not be healthy anymore. It's pain. No one wants to do that. How you can avoid it is with this guy, this term insurance rider, a 1-year term rider. And how it works is that it decreases as the whole life death benefit increases. So what we like to do in a case like this is design it with enough term so we can fund the policy as planned. And if life happens and we can't pay into it anymore, once we're beyond year 7, we can just chop the term rider off altogether. That's quite simple. But adding a 1-year term rider is the method to maximize the cash value and flexibility of a policy. When you look at it, that's how it works. So I hope that you enjoyed this case study. This one was a lot of fun, and it's a case similar to what we see quite a bit, more than just one case here and there. Usually right around this number, I want to start with 6 figures, call it 200K. Then I want to be able to fund 50K per year. Sometimes it's higher. Earlier today, a couple that I mentioned said we want the ability to go up to 100K per year. They've got a small business that is growing at a fast pace. They're doing quite well, and they want to build the policy to be able to handle enough money as the years pass without having to start all over with a new policy. And if they have to, after they're funding 100K per year, that's in their mind a good problem. That means they're stuffing the policy every year and they'll have a lot of cash value. So I do hope that you enjoyed this video. Let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.